Imagine opening your credit card statement and seeing a $5,000 balance. The bill says your minimum payment is only about $150. That sounds surprisingly manageable. You make the payment on time, close the statement, and assume you are slowly solving the problem. But 1 month later, the balance has barely moved. You paid the credit card company more than $150. Yet only about $50 reduced what you actually owed. The rest disappeared into interest. This is the minimum payment trap. The minimum payment can protect your account from becoming immediately delinquent, but it was never designed to eliminate your debt quickly. And when the payment falls as your balance falls, a debt that looks manageable can remain in your life for more than a decade. Credit cards are part of everyday American life. People use them for groceries, gasoline, medical expenses, travel, subscriptions, emergencies, and ordinary household bills. In 2025, more than 8 in 10 American adults had a credit card. Nearly half of cardholders said they had carried a balance at least once during the previous year. That means millions of people were not simply using credit cards as payment tools. They were borrowing money at credit card interest rates. And those rates are expensive. In early 2026, the average interest rate on credit card accounts that were actually being charged interest was above 21%. Many individual cards charge even more. To understand what that rate does, imagine a person named Daniel. Daniel has a $5,000 credit card balance with an annual percentage rate of 24.99%. He stops using the card and promises himself that he will make every minimum payment on time. For this example, assume his card calculates the minimum as the greater of $35, or approximately 1% of the balance, plus the monthly interest. Real credit card formulas vary, but this is a useful illustration of how declining minimum payments can work. During the first month, Daniel's interest charge is a little over $104. His minimum payment is approximately $154. Only about $50 goes toward reducing the original balance. After paying more than $150, Daniel still owes approximately $4,950. The following month, the process repeats. Interest is added to the remaining balance. The minimum payment covers the interest and removes another small amount of principal. Daniel is making progress, but the progress is painfully slow. After 1 full year, Daniel has paid approximately $1,750. That sounds like a major repayment. But roughly $1,180 of those payments went toward interest. His original $5,000 balance has fallen by only about $570. After 12 months of payments, he still owes more than $4,400. Daniel did not miss a payment. He did not make a new purchase. He followed the instructions printed on every statement. But most of his money did not eliminate the debt. It paid the cost of carrying the debt. The problem becomes worse because the minimum payment usually declines as the balance gets smaller. A smaller required payment feels like good news. It gives Daniel more room in his monthly budget. But that smaller payment can also extend the repayment period. As the payment declines, less money is available to reduce the remaining principal. Under the assumptions in this example, Daniel could remain in debt for nearly 17 years. He could pay approximately $8,800 in interest on top of the original $5,000 balance. A $5,000 purchase would ultimately cost him close to $14,000. And that assumes he never uses the card again. One new emergency expense, subscription, restaurant bill, or shopping trip could extend the timeline even further. This is why the minimum payment is one of the most misunderstood numbers in personal finance. The word minimum does not mean recommended. It does not mean affordable. And it does not mean that the payment creates a sensible path out of debt. It simply means this is the lowest amount the card issuer currently requires under the account agreement. Federal rules require credit card statements to contain a minimum payment warning. The statement must estimate how long repayment will take if the customer makes only minimum payments and adds no new charges. It must also show an estimated monthly payment that could eliminate the current balance in approximately 3 years. Many people never study this box. They look at the balance, find the minimum payment, and focus only on surviving the current month. But the warning box may be the most important part of the entire statement. It reveals the difference between keeping the account current and actually becoming debt-free. To understand why the balance moves so slowly, we need to understand how credit card interest is calculated. The annual percentage rate is expressed as a yearly number, but many credit card issuers calculate interest daily using the account's average daily balance. A 24.99% annual rate works out to a daily rate of approximately 0.068%. That looks tiny, but the calculation is applied repeatedly to a balance of thousands of dollars. The longer the balance remains unpaid, the more days the lender can charge for the use of that money. Paying earlier can reduce interest because it lowers the balance used in later daily calculations. Waiting until the final moment may satisfy the due date, but it leaves the larger balance accumulating interest for more days. There is another important concept called the grace period. Many cards allow customers to avoid purchase interest when they pay the full statement balance by the due date. But once a person begins carrying a balance, that protection may no longer apply to new purchases. New transactions can begin generating interest instead of receiving the normal interest-free period. The credit card can shift from being a convenient payment tool into an extremely expensive revolving loan. The rewards can make this easy to ignore. A card may offer points, miles, or cashback worth 1 or 2% of spending. But those rewards become almost meaningless when the cardholder is paying interest above 20%. Earning $20 in rewards while paying $100 in interest is not a financial victory. The rewards are the visible benefit. The interest is the hidden price. Minimum payments can also affect how people think. A $5,000 balance feels frightening. A $150 payment feels manageable. The small required payment separates the pain of buying something from the pain of fully paying for it. A person can purchase furniture, electronics, travel, or emergency repairs today and deal with the real cost over many future years. This is useful when credit solves a genuine emergency, but it becomes dangerous when the minimum payment is mistaken for the true monthly cost of the purchase. The solution is not complicated, but it requires changing the number that controls the repayment. Instead of allowing the card company's declining minimum to determine the payment, choose a fixed amount based on a payoff goal. Return to Daniel's $5,000 balance at 24.99% interest. Under the declining minimum payment example, the debt could last nearly 17 years. But if Daniel pays a fixed $200 every month and makes no new charges, the debt could be gone in approximately 3 years. His total interest would fall to roughly $2,100. $200 is not dramatically higher than his first minimum payment. But unlike the minimum, it does not shrink as the balance falls. Every month, more of that fixed payment begins attacking the principal. As the principal falls, the interest charge also falls. Then even more of the next payment reaches the principal. The same mathematical force that once kept Daniel trapped begins accelerating his escape. Paying $250 would shorten the timeline further. Making an extra payment immediately after receiving income can also reduce the balance before more daily interest accumulates. The best repayment method depends on the person. The debt avalanche method directs extra money toward the card with the highest interest rate, while minimum payments continue on the other accounts. Mathematically, this usually minimizes total interest. The debt snowball method attacks the smallest balance first. It may cost more interest, But some people find that closing an account balance quickly creates motivation. The best strategy is the one that combines strong mathematics with a plan the borrower will actually continue. But every effective strategy begins with the same rule. Stop adding new charges to the balance whenever possible. Trying to repay debt while continuing to use the card is like draining water from a bathtub while the faucet remains open. The payment may be real, the effort may be real, but the balance may never fall. A useful first step is to review the last 3 months of credit card statements. Identify subscriptions, recurring charges, impulse purchases, and expenses that could temporarily move to a debit card or cash budget. Then place the card somewhere less convenient, instead of keeping it saved inside every shopping application. Set automatic payment for at least the minimum to reduce the risk of missing the due date. Then schedule the additional fixed payments separately. The automatic minimum provides protection. The additional payment creates progress. Credit card balances can also affect credit scores. Scoring systems consider how much revolving credit a person is using compared with the total credit available. A high balance relative to the credit limit can hurt even when every payment is made on time. Reducing the balance can therefore improve cash flow, lower interest, and potentially help the borrower's credit profile. But someone who cannot afford the minimum payment should not wait until the account collapses. Contact the credit card company immediately. Some issuers offer hardship arrangements, temporary payment reductions, lower interest rates, or structured repayment options. Explain why the payment is difficult, how much can currently be paid, and when normal payments may be possible again. A reputable non-profit credit counseling organization may also help create a budget or debt management plan. Be extremely careful with companies promising to make debt disappear. Avoid businesses demanding large upfront fees, guaranteeing settlement, or instructing customers to stop communicating with their lenders. The minimum payment trap is powerful because it does not feel like a trap. The account remains open. The payments appear affordable. The customer avoids immediate consequences. But years pass, interest accumulates, and the original purchases may be forgotten long before the debt disappears. The way out begins by asking a different question. Do not ask, "What is the smallest amount I'm allowed to pay this month?" Ask, "What fixed payment will eliminate this balance by a specific date?" The first question protects the credit card account. The second protects your financial future. The minimum payment can keep you current. Only a repayment plan can make you free. This is Money and Power Files. Here, we explain the hidden mathematics, business systems, and financial decisions that shape everyday life. Subscribe, because understanding how money works is the first step toward keeping more of it.